So I will first introduce then CP Chandrashekhar. Chandru is a professor at the Center of Economic Studies and Planning at the Jawaharlal Nehru University in New Delhi. He has published widely, of course, in academic journals and has written and co-written many books, including The Market That Failed, Neoliberal Economic Reforms in India, Demonetization Decoded, A Critique of India's Currency Experiments. And he writes regularly. He's prolific. If you read the Ideas website or Frontline or Business Line, etc. I have to say that I always want to check what Chandru is saying if I'm really puzzling over any important development, economic development, whether in India or internationally. So Chandru, please, the floor is yours.
Okay, thanks, Radhika, for that generous introduction. Yeah, let me start by saying that, the way I'd like to approach the issue of inflation is to treat this as a symptom of the capitalist crisis. That, I mean, what we're really, what we're really bothered about or trying to understand is not really inflation per se, even though that is important, but place it in a context in which we understand what is happening to capitalism. Now, whenever we speak of the return to inflation, I think what we need to recognize that is after the golden age, the great American celebration, the period between the Second World War and the late 1960s and early 70s, which was a period in which we know, in an exceptional sense, capitalism managed to, or advanced capitalism, managed to ensure this combination of a reasonable rate of growth, relatively low inflation, and of course, a near full employment situation for a significant period of time. It almost appeared that all the problems which in some sense the Great Depression brought forth had been resolved, and inflation was not a problem, growth was not a problem, unemployment was not a problem, because you had these three things together working to say that finally we managed in some sense to deal with the instability or the cyclical tendencies in capitalism, and of course the larger crises which we have in a long-term sense. Now, if we go back and ask ourselves the question, why exactly did it become difficult, impossible for capitalism to sustain that golden age in the period after the 1960s? It's a complex story. But among the elements were the following. First, of course, was the inability to be able to ensure the kind of productivity increases which came as a result of the spin-off effects of R&D during the Second World War, which was commercialized in the period after that, and productivity increases which ensured that productivity was rising faster than wages, which obviously managed to hold down inflation. The second was an ability to be able to ensure that commodity prices, largely because of the fact that the way in which the terms of trade were shifted against developing country primary exporters, including, of course, the exporters of energy before the coming of OPEC, that you were in a position to be able to keep down primary product prices so that intermediate costs, including the cost of energy, could be held down so that the possibility of cost plus inflation was limited. And finally, because of that, even to the extent that there was an increase in wages during this period when unemployment was low in the developed industrial societies, in particular the United States and Germany, etc., you were able to actually ensure that this didn't translate into inflation, not merely because of the fact that you had productivity increases which were significant, but also because of the fact that you were not able, you were able to actually translate, whenever there was a problem, translate the burden of adjusting for inflation onto the shoulders of the exporters of primary commodities. They took the beating in the shift in the international terms of exchange in order to be able to hold inflation at the core. Okay, and it was the inability to be able to ensure this and other circumstances, which in some sense provided the basis, besides Keynesianism, etc., which we speak of, as the flow on the basis of which you could have the golden age, which gave way in the late 1960s and early 70s. Well, the reasons for that we know. First, of course, there was the coming together of the OPEC countries, governments in OPEC countries, which nationalized the oil resources, formed the cartel, pushed up prices. Long years of boom basically meant commodity prices were tending to rise, and you ended up with a situation, therefore, that one way of making this adjustment, if you continued with a world in which if you couldn't continue in a world in which productivity advance was faster than money wage increases in the developed countries, which is what it became because of the fact that you couldn't sustain that kind of a whatever post-war scientific and technological revolution, if you wanted to call it that. You ended up with a situation where productivity was not rising as fast as money wages, and you couldn't shift the burden of the adjustment onto primary producers to the same scale. Okay. Now, what did the Great Moderation do? The period in which post, of course, what Paul Volcker did, the monetary stringency, the cutback in spending, etc., which essentially said that, okay, we're going to in some sense contract demand. We're going to move metropolitan capitalism away from manufacturing per se for the generation of profit into finance. And what did you do? You essentially said that we're going to have a set of things which we're going to exploit. Of course, it wasn't a conspiracy in that sense, but that's the way the capitalist game played out, is that one, of course, you could ensure that any threat which came from rising money wages at the metropolitan core could be handled by what you had mentioned in your introduction, through a relocation of manufacturing production to all the centers through the process of globalization that came with the rise to dominance of finance, to centers in which were actually the home to the largest amounts of the reserve army of labor, which is available at relatively low wage costs, which not merely held down wage costs in production, but obviously meant that it had an impact on what happened to wages in the metropolitan core as well, or at least the increase in wages in the metropolitan core. The second was that you broke the back of OPEC. You managed accepting for cyclical shifts at different points of time. You managed once again to be able to bring under control the commodity price boom to the extent that it operated in the latter stages of the Great American Celebration. And you ended up with a situation in which you were operating the system at a level of economic activity outside the realm of finance, which actually meant that demand was rising at a rate relative to the ability to be able to ensure cheap supplies from a globalized environment at levels at which prices didn't tend to rise. So you had this unusual situation, for example, where you could have no inflation, in the sense of an increase in the prices of goods and services, but you had huge asset price inflation. So much so that when this was raised, Greenspan basically said, why should we take a shift towards a less easy monetary policy? Because I don't see any inflation, I don't see any bubble. There might be a little bit of froth, but there's no bubble. And on the other hand, you didn't treat asset price inflation as part of inflation, and that's how you sustain this whole process. Now, I think to sort of bring this to an end, I think we have to ask ourselves the question now, therefore, is why couldn't you continue that, particularly in the period after the end, that is pre-COVID, as the growth process was slowing down at a point of time when therefore you're really talking about, in some sense, some kind of a demand contraction which is occurring even in the metropolitan countries. And of course, you had COVID, which of course affected demand as well. Why were you not in a position post that? Because that is the surprise. I mean, maybe if we're accepting for, a Lawrence Summers or some, or one or two, everybody said that this inflation is transitory. It essentially is coming because of temporary supply constraints, which are going to get resolved once we get the pandemic to wane, even if not go away. And therefore, really, the surprise was, how come it's not transitory? How come it's still with us? And if we look at it, we have, I think, a multiple set of factors which have undermined the ability of imperialism and the metropolitan capitalism to do what it did during the period of the Great Moderation. First, I do think that because of the fact that you created this global supply chains as a part of the process of ensuring the Great Moderation by relocating a whole host of production away from this metropolitan core in order to exploit cheap labor, you've ended up with a situation that if there is any increase in demand in the metropolitan core in response to the crisis, as happened because of the fact that the only countries which use fiscal policy as a significant way of addressing the COVID pandemic or even the pre-pandemic recession, that these were countries in which you were seeing some increase in demand. And that increase in demand, however, was not being matched by supply because of the fact that the uneven distribution of the supply constraint which the pandemic and other factors that ensured, including the effect it had on transportation, meant that there was an asymmetry in the response of demand and supply as the pandemic waned. That demand was rising, but on the other hand, your expectation that automatically supply would adjust because things are getting better now, we don't have lockdowns, etc., that wasn't happening because of the fact that each time you had one set of lockdowns going, you had another set of lockdowns coming up, either because of another wave or because there were concentrated locations in which the problem arose, as for example in Beijing and Shanghai currently. Okay, the second thing I think with respect to that is really not merely did you have this inability for supply to adjust, but long years of allowing this kind of globalization to proceed essentially meant that any effort to assert metropolitan dominance through using the economic lever or by fighting proxy wars, that actually, feeds back. So you can say that I'm going to impose sanctions on China because they are stealing our secrets or technological secrets. But if you begin to do that, you do something to the supply chain. You can say that, okay, we're not happy with what Russia is doing in Ukraine, and we're going to allow these countries to be part of NATO. Fine, that might be a position. But the moment that begins to happen, you realize that, listen, this is uncontrollable. It's even uncontrollable in Europe, which is so dependent on gas imports from Russia. So you actually have a situation where the earlier way in which you tried to manage hegemony in some sense, or that actually now works back. It works back in terms of your ability to be able to ensure not great growth, which you didn't anyway ensure, but to ensure some kind of stability within capitalism of the kind that you have. The third factor, I think, which I think is important, is that the transition to finance, the tendency to allow growth to ride on bubbles, essentially means that now it's not just demand and supply imbalances which determine price, which anyway were not the main thing. But essentially what you have is a tendency for speculative factors to play a major role because of speculative finance entering the scene. If you look at what is happening in food markets now, for example, Lighthouse Reports has done this study, which basically points to the fact that much of the exposures in futures markets in food commodities is on account of private equity firms, etc. So you're ending up with a situation where the speculative play, which earlier was in equity and bond markets and generated asset price inflation in the developed countries and delivered much riches to the top 1%, now is working to actually ensure a situation where you're not in a position to be able to control inflation because speculative capital steps in the moment you have any sort of imbalance, which actually tends to push up prices. So you put all of this together, and in some sense, what we're saying is that this surprise as to why is this inflation not being transitory is a surprise which disappears once we realize that in some sense, the dominance of the global economy by a set of metropolitan powers has generated a transition or a process of development which actually has feeds back in a way in which the ability it had to ensure the great moderation or the ability it had to ensure the golden age actually is no more. And using monetary policy as a device to try and address that only worsens the problem, which I can, of course, take up in the questions. I'm sorry, I think I've exceeded my time by a couple of minutes.
I'm Michael Hudson. I'm appearing here for the International Manifesto Group. If you like this video and ones like it, please subscribe. For more information, go to the address on the screen.